KFC ranked worst out of 76 restaurant chains per new market share analysis. The chicken wars are taking their toll. New Barclay analysis suggests that competitors close in on the chain that once ruled the roost. Though it's been rising steadily for decades now, America's taste for chicken has really taken off in recent years. Consumption keeps hitting new highs. It's become a value option. It feels like even major fast food chain over the last year so has hit a chicken stripe, shape panic, bottom to revive sales a hole in the bucket. You might imagine all of that has been great news for Yum Brand's biggest chain KFC, which counted roughly 33,000 restaurants around the world toward the end of last year. However, if recent U.S. market share figures compiled by Barclay analysis led by Jeffrey Bernstein are anything to go by, you'd be wrong. Chickened out. KFC has been losing ground since 2019. Chipotle, Texas, Olive Garden, Domino's, First Watch, Dave and Buster's, Pizza Hut, Taco Bell, Outback KFC. According to the new data, the finger licking good chain, which traces its root back to a motel in Corbin, Kentucky almost 100 years ago, took a 15% share of sales in the U.S. quick service chicken restaurant and sales sector back in 2019. Just 5 years later, that figure just slumped to 9.4% as competitors like Dave's Hot Chicken, Julie Beef Slim Chickens, and Wingspot and have taken huge bits out of KFC. Huge bites. Later of those, Wingspot have done particularly well, having seen its market share jump from 4.8% to 8.4% over the last over the same time frame. Indeed, other than restaurant chain, out of the 76 tracked by Barclays lost more than market share than KFC in their respective cuisine category, KFC being quick serve chicken. The reports for Barclays won't make great ready for Yum as well either with its other two major brands, Pizza Hut and Taco Bell, amongst among restaurants in industry's biggest market share losers have shared 3.4% and 4.1% in their cuisine category respectively. Meanwhile, Pilot has doubled gain across all the cuisines from 2009 to 2024 with its share of sales Mexican quickly service restaurants area soaring 8.3%, even a sign of slope bowl supremacy might starting taper of emergency. Iconic hot dog brand Nathan's Famous just sold for $450 million. Packaged meat company Smith Feldfood has agreed to acquire historic Coney Island stable, best known for its annual hot dog eating contests. It's all cash deal. Paramount is doing everything except the one thing that could give its Warner Brothers Big Beat a chance of success. Warner Bros. Says more than 93% of its shareholders have rejected Paramount. That's probably not going to change sustainability unless Paramount boosts offer. Paramount is doing everything except one thing that could give its Warner Brothers Big a chance of success. Warner Brothers say more than 93% of its shareholders rejected Paramount. That's probably not going to change sustainability unless Paramount boost is over. Paramount Skydance just said it would extend the deadline for Warner Brothers Discovery shareholders to turn their stock onto its hostile bid, a move that does nothing except the underscore that Paramount is trying everything except that one thing that might actually work, raising its offer. To Thursday's announcement that Paramount is not giving shareholders until February 20th to consider tendering their shares to hostile takeover effort. Its last bustery neighbor, Nothing Burger, is a series of them for David Ellison run Paramount. This thing that would persuade shareholders to support Paramount bid the same thing that persuaded shareholders to do anything, more money, and so far, Paramount hasn't been willing to pony use and more cash. Instead, it first offers Larry Ellison backstop for its 30 per share dollars offer. That doesn't change the amount of money the shareholder could get out of the deal. Then it reiterates its offer, which lasted, I checked, doesn't mean any money for the shareholders. Then the Paramount said it would launch a proxy fight in order to replace Warner Brothers board member of people who are more favorable Paramount bid. It's just one problem: winning a proxy fight requires shareholder support, which is the same thing that winning a hostile takeover bid requires. If you don't have enough direct support from your offer from shareholders, you're not going to get them to support your pursuit of new directors like you offer either. Now, Paramount extended the duration of its offer onto its month, which is a pretty clear indicator that so far it has gotten the support it needs from the shareholders base. Warner Bros. Thursday seemed to confirm as much, telling Variety in a statement that 93% of its shareholders has rejected Paramount's inferior scheme. Meanwhile, Netflix with I've said like prevail its pursuit has been outmaneuvering Paramount, with Netflix stock falling in value. The company flipped over to all cash in order to shore up support from Warner Brothers shareholders. Now there's no stock prices manipulated involved. Netflix is offering to pay 27.75% of cash for most Warner Brothers, with a spin out reportedly generated several additional dollars per share value. Meanwhile, Paramount is offering $30 per share in cash for whole company. Perhaps it is still static. Paramount waits for someone lodging regulatory challenge. Fear of a deal not going through taking a long time to go through might persuade shareholders to look at the competing offer. David Allison has been taking his fight to Europe, in hopes that regulators will oppose the deal. Perhaps he's just hoped that he can do something really exceptional convincing. That reports that Allison and his team have been meeting with Warner Brothers invested in recent weeks to lobby support. But bottom line, especially considering that papers have been signed on Netflix Warner Brothers deal and break up the fees would be in order if doesn't go through that money talks. If Paramount wants to snatch victory over the jaw of defeat, what it done so far would has been rejected by Warner Brothers board twice under their statements. To be believed in the process of being rejected by Warner Brothers shareholders, it isn't go to work, no matter how loudly it crows. Instead of success, Paramount simply has to do one thing so far has been unwillingly to. Streamers continued retreating from original shows in 2025. America's love for spicy food and mouth-tingling sauce has surged, but are we approaching peak heat? Netflix made $1.5 billion from advertising last year, about 3% of its total revenue. Stock whips sold ahead of next week's big tech earnings. Active ETF offers exposure to Elon Musk's SpaceX. Active ETF bearing first principles of ETF has added a large stake in Elon Musk's private hold SpaceX, with daily disclosures of active ETF holdings on Friday showing Space now makes up 22% of the fund portfolio. Such a stake would open up potential big opportunity for those looking to get access to some of the eccentric billionaire's private hold business empire ahead of any public offers of the shares, which is reported in the weeks of this year. The top holdings in Barron's first principles ETFs are Elon Musk's companies.